more, I don't want to make it sound like you have a point of view other than you're expecting a more hawkish Fed, and Barry, you're expecting one that's a little bit more dovish. So Tom, you're more in line with consensus right now. What would that look like, and why are you still bullish on stock prices?
Well, I think precisely because our clients are expecting a hawkish cut. So exactly as Steve laid out, Fed does a cut, but future cuts are uncertain, not even maybe until June. Now, because that's the base case, then if that's what happens, of course, markets have already been bracing for that, and they've been bracing for it since October. And of course, there's a chance that it's a dovish cut, which would be bullish as well. And then I think
what to you would be a dovish cut? So, are there projections? Are there dots?
Yes.
There is. So we'll know right away if they come out and those projections show that they're expecting more rate cuts next year. Then you're saying we might only get one more in the summer.
That's right, and it could also be interpreted dovishly if they start acknowledging the balance of risks are shifting, so that then markets can realize the Fed is now acknowledging there's some underlying fragility of the economy. And of course, now QE is because QT is ending. It's essentially not QT, which is QE, and there's, of course, the chance that there's something positive the Fed has to say. So I think it is a hawkish cut, but actually I think market reaction's positive.
And there's so much more you're queuing up here we're going to get into, but on a top level, why isn't it a bigger roadblock for markets, Tom? You could look at this and just say, well, we're already basically at all-time highs. Look at the Russells and so forth. And Powell's been known to not have a very favorable reaction to his commentary, and he's only got a few meetings left, so maybe he's even more hawkish than usual. I don't know. Why don't you think that's a bigger risk? And whether it's, I'm not just myopically even talking about this afternoon, but kind of setting the tone into year end and then into next year.
Yeah. I think part of it is just the market's now adjusted to the idea that the Fed is institutionally slightly hawkish. Now, part of it may be because that there could be undue pressure coming from outside the Fed, and the institution wants to protect its integrity, and that comes across as hawkish. But that dynamic is something the markets have been bracing for, and they've reacted negatively to it, like in October they did. And so I think because of that, that's what people are building into this December meeting, which is why it could be a surprise.
It's like when Apple always gives cautious guidance. The stock always sells off after earnings, and then it does fine again. And they also, of course, have the post-COVID period to react to, where you know that someone like Powell, who's about to leave, is going to want to say, I didn't reopen the door to inflation, right?
Yeah, that's right.
For that
protect
institutional
his legacy.
Exactly. So, Barry, all of that said and done, there are still lots of people starting to talk about this quantitative easing issue. So it's a little bit confusing when you have, are we to view that even as economic policy making, or is that something completely different that just has to do with the plumbing of the financial system?
So for 3 years, you and I have been talking about the Fed eased primarily using their balance sheet, but tightened using only one of three channels that they have, which is they've just been draining reserves from the system. And so that's the plumbing issue, which is getting tight. But the much more important and impactful part of QE is when they're buying Treasury notes and mortgage-backed securities. That lowers long-term rates, which is what really influences equity prices and other risky assets. And they suppress volatility by buying mortgage-backed securities because of prepayment.
When do you expect them to come back into the market, the Treasury market?
Well, it is not lost on me, it shouldn't be lost on any investor, that the 10-year Treasury yield has moved from 3.99 on December 1st to 4.20 since the Fed began what I'm calling DT, duration tightening.
Oh, no, now I'm confused.
Right,
Keep going.
Now they're reinvesting their mortgage-backed securities pay downs into Treasury bills, not into Treasury notes.
Right.
So that means they're buying 17 fewer billion per month of we'll call them 5-year Treasuries for simplicity's sake, and they're buying bills instead. And so that's putting upward pressure on longer term rates. This is when Kevin Warsh talks about shrinking the Fed's balance sheet to encourage private sector lending, he's skipped a step in there. The step is deregulating the banking sector, lowering the GSIB surcharge, widening the supplementary leverage ratio, doing all these things that could potentially expand bank balance sheets as much as $6 trillion from the 22 or 3 or so billion that they currently are.
That they should be the buyers.
They own the debt. This is crucial in the long run that a price-sensitive buyer owns the government debt, not a price insensitive buyer. So when the government starts spending like drunken sailors, as they did in 2020 and 21, and
Some
drive
pressure will be
spending to
put on them.
30% of GDP,
Right.
they're not able to just
Keep going.
finance it
Yeah.
and keep going. And so this is a crucial transition that needs to happen this year.
But the reason
so yes, I'm a dovish on the Fed cutting the policy rate to try and steepen the yield curve so small banks can participate in this
Right.
process.
That's what Paul
as
McCulley
well.
talked about. A lot of people are saying they should cut because they want to renormalize the yield curve.
That's right. So their policy rate has been overly restrictive for floating rate borrowers, small businesses, Russell 2000 companies. You know, Tom and I have tried to get bullish on the Russell 2000 for the last couple of years.
Right.
This is part of the reason why it hasn't worked. But policy's been accommodative for long-term fixed rate borrowers, investment grade companies, relative to high yield companies, for example. So for me, it's crucial that they allow that duration to return to the wild, go back into the market, reinvest in bills, but lower that short-term rate. And
But just
net,
to put a
it's-
point on that, so I can follow you when you say, look, the rate is too high, it can come down a little bit, fine. But then they also need to restart QE. Okay, I guess they do.
they're not
but
going to restart QE. If I'm right about deregulating the banking sector,
They're going to
it'll
restart
be totally
QE.
unnecessary.
They're going to restart QE. They're
It'll be
already
totally-
saying, they're already basically
it'll be
admitting to that.
Well, Powell's not going to be chairman anymore. And integral into what Bessent is asking the next Fed chair to do is deregulate the banking sector. If the banking sector doesn't need to hold $3 trillion of reserves because the requirements don't
Then they don't
force
need to
them
worry about the balance
then
sheet. Yeah.
we're not going to have tight repo rates.
Yeah.
So that's how we avoid the Fed expanding their balance sheet and interfering with the price of the most important security in global markets, the 10-year Treasury.
Absolutely, but Tom, the reason why we fixate on this, which sounds wonky, but it's not, especially if you're in the crypto world, for instance, where you hear people saying QE is coming, the liquidity is coming, buy Bitcoin or buy whatever crypto asset or buy stocks because this is coming. So it's important to know whether it's coming or not.
Comes from the banks, though.
Yeah,
Fair.
But yeah, in the crypto world, QT was draining liquidity. So the ending of QT is essentially QE, because if they're just holding the balance sheet flat, they are still going to be essentially adding liquidity to the system.
Just to maintain the size.
Yes, and so that is why I think crypto prices have risen in anticipation of this meeting.
So do crypto prices keep going? Do you have a bullish view still on small caps if we're finally going to get that rate coming down a little bit? Where should people look for alpha or outperformance?
Yeah, I mean, like 2026 is a year like there's a new Fed, right? But a dovish tilt. And at a time when the ISM's been below 50 for a record more than 3 years. So that's really good for small caps. And as Barry says, if they deregulate banking, and we were talking about this offline, that's really good for small caps. But that's also really good for the business cycle. And we've talked about this in some of our past research. Crypto prices are really sensitive to the ISM. So the ISM moving back above 50 has historically been associated with actually super cycle moves in Bitcoin and Ethereum.
Wait, ISM going into expansion territory is positive for Bitcoin? And
Correct.
for all, interesting.
Yeah, and so if you look at ISM and Bitcoin, and you detrend Bitcoin, essentially look at its distance from the 200-day, it's almost perfectly correlated to the ISM.
Surprising.
And
but
same thing with copper to gold prices. So copper's an industrial metal versus gold is a monetary.
right, but all of that tells you that it's basically just risk on, that they're all behaving like an economy. And am I overcharacterizing
Yeah, I think
it?
I think that's right. I think Bitcoin's a bit of a chameleon because there'll probably be a time when it acts like gold, but right now it acts a lot more like it's sensitive to monetary policy and the business cycle, and both are about to turn up. So that would mean anybody who thinks the Bitcoin 4-year cycle means crypto prices are down next year, we're betting against that thinking that new highs come early